Okay? Sound all right? Okay, why don't we go ahead and get started. Welcome, everybody. Good afternoon. Thank you for being here. My name is Ben Salm. For those of you who don't know me, I'm the Managing Director for our Securities Analysis Center here at the College of Business. And ours is the program in finance and accounting here at the college. And one of the things that is important to us, like our other companion programs here at the college, is to involve industry as much as possible in everything that we do, to give our students the chance to work closely with industry leaders, to collaborate with them, to hear from them as often as possible. And that's what today's panel event is all about. So we're here today to share some of that with you at a time when remarkable and amazing things have been happening in the U.S. economy and in the financial markets. So through these professionals who spend their days, all day, every day, working in the markets and thinking about this stuff, come down to offer some information and some insights and maybe a little bit of perspective so that we can all get our heads around what's going on a little bit more easily. Now what's happened, and of course, things are changing every day, so what's coming up in the next few weeks. So let me introduce our panel. The format today will be a few minutes to open up the discussion, introduce the topic. We have a few prepared slides, and then we'll turn over to our panelists for a few minutes for their main points, each of them. We have a couple of prepared questions, and then we'll open it up to you for your thoughts and your questions and finish off our session with an interactive dialogue. Starting on my near right, Ron Sauer, who is the founder and chief executive of Mazama Capital in Portland, a graduate of this college and one of the founders of our Securities Analysis Center. Mazama Capital is one of the country's largest investment managers for small and mid-cap U.S. equities. John Chalmers, professor of finance and head of our finance department. Among other areas of expertise, John's research expertise is stock market, investor behavior, mutual funds, all things that are pretty timely this week, so we'll hear all about that. And Bob Jesenik, chief executive of Aequitas Capital in Lake Oswego. Bob's also a graduate of this college. Also, Aequitas is one of the founders of our center. Aequitas Capital is a firm involved in the direct investment in other firms by way of private equity, and also with a lot of activity and background in the lending, debt, and credit markets as well. So welcome to you all. Now, there's an awful lot that's happened in a really short period of time. This past week was the worst week for the stock market since, well, in some cases ever. In other cases, since the Depression. And this is not just a U.S. phenomenon, but it's gone global. And it's happened very swiftly and very dramatically. So none of us is going to pretend that we have a lot of answers. I mean, we're all in this together right now in uncharted territory. We're all students of economics and finance at the moment. These are just some of the highlights, most of which have taken place in just the last month. So names that you've heard, that you've seen, read about. At the beginning of the year, there were 5 investment banks based in New York City, some of the most profitable, envied, influential, sought-after firms in the world, absolute blue chips names. They're all gone now. Gone or transformed. Bear Stearns was the first back in March, went bankrupt. Goldman Sachs and Morgan Stanley have survived, but they are now banks, which radically alters their business model going forward and their profitability. Merrill Lynch was taken over within the last month, and Lehman Brothers has gone bankrupt. 5 arguably the most influential firms in the areas of finance, radically gone. A completely different landscape now. In addition, Washington Mutual and Wachovia, banks that we read about, and others that have gone bankrupt. So this is just a partial list, all essentially within the last 4 weeks. If you look back to 2007, there was a first indication that something really important might actually be happening back in the summer of 2007. That's when the first real sign was Bear Stearns was managing 2 hedge funds that collapsed. And they collapsed in large part because they were heavily invested in mortgage securities and lost enough money that they really imploded. And Bear Stearns, that was summer of 2007. Bear Stearns, 9 months later, would be gone. There was another company known as New Century, And I'm just picking these out because they're good examples. New Century had a terrific book of business and a very aggressive stock price. It was a real star in the stock market for 4 or 5 years up until 2007. It went bankrupt, and its business was lending to subprime borrowers. So the business model that worked so well for so long, we've had well over a year to digest how things have really changed. But it's just in the last month things have really started to happen. Mortgages, we know, we read about, are at the center of everything going on. They're certainly the catalyst, if not always the reason. For those of you who read the book, you might recognize this slide. This is from Robert Shiller. He wrote a book 3 years ago, and among other things, they took the trouble to go back and reconstruct house prices as best as someone could historically, going back over 100 years in the U.S. And this chart, what we want you to notice most of all is this red line here. This is a chart representing 20 to 30 metropolitan areas in the U.S., historical returns to house prices. And what you can see is that this is back in the late 1800s. You could draw a straight line up until the late 1990s. The return to housing, as measured by this index, was actually just a little bit under 1% per year once you adjust for inflation. And then something happened. This is about 1997 or so right there. And something very unusual and abnormal. And it wasn't because population increased or that the cost of actually building a house changed. It was due to something else. That something else, among other things, mortgage debt. Now, these are government statistics. If you look at the total debt outstanding beginning in about 1974, total mortgage debt outstanding in the country, you can see it's increasing at a fairly steady rate, again, up until mid-1990s, and then it really starts to spike upwards from about $2 trillion up to about $10 trillion during the course of the period, and about 2.5 times just in less than the last 10 years. Houses were getting more expensive. People were taking out larger mortgages. They were also borrowing against their homes. And the other thing that you see is that the blue line that's descending is actually the aggregate amount of the house that's actually owned by the mortgage holder. So Americans were left with less equity in their homes. What used to back in the 1970s be about roughly 70% equities across the country in homes fell pretty steadily until it's down about 50%. So in terms of mortgages, Americans have never really been levered as much as before. That's fairly indicative of other loans as well. This is a chart, it's a little bit busy. This is a chart of total debt and income as well. So the pink line here, disposable personal income. Again, these are government statistics. This is what you and I bring home by way of income that we have available to spend. This is the typical way that the government measures these things. So again, starting early in the 70s, rising at a pretty steady rate. The blue line is the total household debt. So that includes credit cards, student loans, auto loans, mortgages. And you can see it starts to diverge early to mid-80s and then really picks up speed, and the gap gets pretty wide. So as you look and think about the role of credit in the U.S. economy and how that's changed over the years, in pretty stark relief here in terms of how it's been used in many, many cases. This is the savings rate as measured what percentage of disposable personal income that typically gets saved by Americans. Again, used to be about 10%, historically fairly stable. Falling, it's essentially zero now. So this thing that we read about, the credit crunch, the credit crisis, banks' unwillingness or inability to lend, affects us that much more because of these kinds of things, because Americans have, in so many ways, never really been quite as much debt as before and have become so much more reliant on credit, short-term credit, long-term credit as well, mortgages and other things as well, leaving us pretty vulnerable to the kind of swiftness, maybe, and actions that we've seen lately. Credit's important everywhere. This is it's the last technical chart. This is a chart of the cost of what it costs banks to lend to one another. An important part of the credit system is banks being able to shuttle loans back and forth to each other to get the capital to lend to the places where it's needed most. And the rate that they charge each other is known as LIBOR, which is just the London Interbank Offering Rate. And it's a sign of just how expensive or easy it is to receive a loan if you're a bank from another loan. Pretty steady here. The rate was at 2%. This is just a 3-month chart, so this is just recent history. Then in September, it spikes up to almost 4%, indicating the bank's unwillingness or inability to lend amongst each other. Maybe hoarding cash, maybe not trusting the collateral on the other side. But this is probably just about, arguably, the main source of problem that the Federal Reserve and the Treasury are trying to address right now. Because if banks are really not willing and able to lend to one another, it makes it that much more difficult for them to lend to you and I, and just seizes up the whole system. So this kind of liquidity is really where it all starts, the economic activity. And this is a big, big part of the problem. This chart runs out at the end of September. Today's LIBOR rate, or actually as of yesterday, was actually 4.5%. It's climbed just a little bit more, so it's actually off the chart. So the government comes up with something known as a rescue package, and this changes almost daily, so I'm not too wedded to these facts here. We're not exactly sure what it means, and we're even less sure about how it's going to get implemented, but broadly speaking, some things seem more clear than others. It was originally proposed to cost about $700 billion, and it was originally designed to buy up some of the bad mortgage debt that's held by banks and others, and that will probably still happen, but now they're floating other ideas as well, including direct investment in banks, which would mean in exchange for stock, really. So a part nationalization, if you will, of the banking system or the banks that choose to participate. The United Kingdom just did that in a big way this week with their largest banks, offering capital to some of the biggest names in the business in exchange for preferred shares. So in a way now we're following their lead, but it's unclear. They're still working on the details, which road or which combination they're going to choose. It's supposed to involve $250 billion now and the rest later in a couple of chunks. The reason, again, is to provide some confidence, inject some new capital, and try to clean up, get the system moving again. How they buy the mortgages, if they do, they talk about a reverse auction, which really means since they're the only buyer, they start with the lowest price ones first so that the taxpayer doesn't take as big a hit as we need to, hopefully, but that too is unclear. And I won't read through all of these things, but some of the more notable things, trying to limit executive pay, make it possible for individual mortgages to be amended. There was $150 billion in tax breaks thrown in just to get the votes necessary in Congress to pass this, unfortunately. They did increase our savings insurance for the FDIC to about $250,000, and they're talking about removing that cap altogether. So this is all being worked on. It's all still very much a work in progress at the moment. Last slide. These slides, by the way, will be available to you after this presentation on our website. So if you have a copy of this, you'll find information about our program, about the panelists, and also where to find these slides if you want to go back and review. So $700 billion looks like this. This year's government budget is expected to come in at almost $3 trillion. That's what is expected to be spent, not including what's going on today. So it includes none of this. This was a prior estimate. The government deficit also projected to come in at almost $440 billion this year. That does not include the wars, or the military actions in Iraq and other places. And our current public debt, what we owe the rest of the world at the moment, is about $10.2 trillion. So however you look at these numbers, $700 billion, it's pretty large in its own right, and it's still a pretty fair chunk in relation to these other things. So hopefully that's some information to get you started. John Chalmers is going to take over and take you some other places now.
Thank you, Ben. So my name is John Chalmers. I'm a finance professor here at the Lundquist College of Business, and it's kind of a pleasure and great fear that brings me here, in the sense that lots of people in the hallways are asking me, you know, you're a finance professor, what's going on? And I think the most honest answer is, you know, I don't know. What we can do, though, is we can provide some perspective on what's been going on, and I hope that some of you have seen or are fans of Monty Python and the Holy Grail, but you may recall the scene where the Black Knight has just lost one arm in a duel, in a sword duel, and then he loses the other, and he says, "Merely a flesh wound." So I think it would be fair to say that right now this is where we are for the year. So we're down 40%. I think that's the same kind of flesh wound that the Black Knight was suffering. And what this chart does is it actually provides you with an idea and some perspective on what markets have done since 1926. So here we have the Great Depression era. You can see it was worse then. Okay, so we had several years in a row of terrible returns for those calendar years. You know, here's almost 40%, here's 60%, here's more than 40%, all within that decade in that range. We have right here is the 2000 period. You know, that was right around all the dot-com companies. People decided they weren't worth quite as much. And then here we are today in 2008. The other thing I want to point out on this, just kind of a view of history, is what volatility is doing. So volatility is kind of the level of uncertainty in the economy, how much people disagree about what things are worth, how much values are varying. And yesterday was one of the most volatile days of trading that we've seen, in the sense that I think at one point we were down as much as 7% on the S&P, maybe it was only 6%. And then we went up above zero for a little while, and then we came back down and finished about 1% below. So we covered a large range of value in one 8-hour period. But what we're seeing here is our volatility levels kind of for 2008 are still kind of less than what they were in the Great Depression area, but nonetheless they're on their way up. They're relatively high. Here's another chart, which may look very busy, and it is, but it's what it's meant to kind of convey is again the sense that we've had a very bad couple of weeks, even by historical standards. So if we look here, these dots right here represent daily returns in the year 2008. These dots over here represent daily returns back in the kind of the 20s and 30s. And right here is the crash of '87. And so what you'll see is there aren't too many dots below these if we kind of look across time. And we haven't had too many days like we've seen over the last couple weeks. And we're seeing that, so just to put this in perspective, if it felt bad, this has been pretty bad. Now what I wanted to kind of just talk a little bit about, lots of people have had questions about, what's this connection between the people that are lending money and the businesses and the individuals who live in our society? And it seemed like it was worth at least thinking about walking through these connections in a very simplistic way. We start out with firms who require short-term borrowings to make payroll, to buy inputs, to finance inventories, to do the things to run their business on a daily basis. Lots of people have lines of credit at their bank account. You have overdraft protection on your checking account so that if you have a large expense you need to pay for and you know you're going to get paid in three weeks, you can pay for it now. You can take care of it, and then you can pay it back when you get paid. Businesses kind of continually operate that way. Now, commercial paper, which is one of the vehicles for short-term borrowing, as well as lines of credit, provide access to capital that keep the wheels rolling. So businesses need that capital to keep their business going, to keep making the products that they're selling, providing the services that they're providing. So the ability to borrow and to invest and to smooth these short-term fluctuations in cash is critical to the operations of many businesses, households, nonprofits, virtually everybody. And how does that then connect to the stock market? Well, the stock market value is going to reflect a concern that our system's breaking down, where even credit-worthy borrowers aren't able to go and get this short-term capital to make their business run smoothly. So we're seeing very strong companies that are having difficulty kind of getting access to the blood that kind of keeps the company going. And we also have a great deal of evidence that, things are definitely different. There's something very different happening right now. And a lot of these observations have been occurring for several months. I mentioned commercial paper. Again, that is a very, like a 90-day, there are different lengths, but a very short-term borrowing that corporations use, very short-term form of debt that corporations use to finance their everyday operations. And General Electric, one of the bluest of the blue chips, was having trouble selling its commercial paper. Okay, they were able to do it. Once the government came in and guaranteed it, they were especially able to do it. But they had trouble, which causes some pause. Lines of credit, and Ben already showed you the chart of LIBOR, which is the rate at which banks loan to each other. Lines of credit have been rising to very high levels. Adjustable rate preferred stock. This is kind of an arcane form of capital used in many corporations, but this is a market that broke down about, I think, probably 4 or 6 months ago. It used to be just like clockwork. You kind of went to a market, you sold this stock, you sold this adjustable rate preferred. People bought it, people sold it, and everything worked like clockwork. All of a sudden, it just quit working. No one was there to buy it. And people that wanted and in fact needed to sell it weren't able to do so. The municipal bond market, which is an area that I've done a lot of research in, is we're seeing incredibly high yields on municipal bonds relative to treasuries. So U.S. treasuries, I think one of the good things is that people still believe in U.S. treasuries. They still believe that we're going to get paid back by the government. But if you see these treasuries, you see are paying right now for a 10-year treasury, you get an interest payment of approximately 3.87%. In a municipal bond, a AAA, where the state of Oregon, say, is guaranteeing the payments with the taxing power of the state, might pay you 436 as of yesterday, something like that. So you're getting 436 from a municipal bond from a state that can use its taxing power to pay you back, and you're not having to pay taxes on that. You're getting 387 from the government. You've got to pay federal taxes on that. So you're going to pay, say, 30% on that. So you get about 0.7 times that will be what you get to spend. So this has never happened this has been like this for a little while, but up until this last year, that had never happened before. It had never looked like that. Did I skip one? Okay. So here's some of my favorite tools. So WD-40, I didn't put duct tape up here, but as a kid, I was a salmon fisherman in Alaska, and as long as you had duct tape and WD-40 and a hammer and a wrench, you could fix anything. So WD-40, we kind of need something to loosen up, to get our credit markets working again. And some of the tools that certainly have been talked about and bandied about, and some of them are being implemented, are guarantees, capital infusion, asset purchases. I think guarantees we're seeing in the form of the increased FDIC insurance limits from $100,000 up to $250,000. I think that's a great step. Capital infusion into banks, so they're talking about actually buying equity in banks, putting money right in there. They're also talking about buying the bad assets out of the banks. And this is probably of the list my least favorite, in the sense that it's very difficult to start buying things that you don't know their value. It's unclear how that's going to turn out in the end. What we really need to start seeing happen is people to trust each other. What we don't have right now is trust and transparency in our markets. And the problem is that the collateral that people are able to give is collateral that no one knows exactly what it's worth. And so when that's the case, what do people do? They sit on their hands and they say, you know what, until I know what that's worth, I don't think I'm going to buy that. And I'm not going to make that investment. So again, we're trying lots of things in the markets, and the government is working internationally to try and coordinate these efforts. And I certainly think they're certainly hitting on many of the important issues. Well, so this is some good news. One of the things that I've heard a little bit about this in the press, and I heard about this from one of my colleagues who I do research on mutual funds with, and he was saying he sits on a national board of credit unions, and he told me, credit unions are actually doing pretty well, which got me to thinking. And so what I did was I collected what do delinquencies look like at banks. And so this dark blue line are the biggest 100 banks. This purple line are the banks that are out of the top 100 banks. And what's represented in this graph are delinquencies on first and second mortgages for the banks. And what you might see is that they've gone up to almost 4.5% for the biggest banks. If we go and we look at these smaller banks, this would include small community banks, there are substantially lower delinquencies at those banks. And then if you come down here to the credit unions, so we're about 4.5% delinquency rates on first and second mortgages for large banks. If you come down here to the local credit unions across the country, the delinquency rates there are about 0.78%. So less than 1/4 of the delinquency rates at the large banks in the local credit unions. And in fact, very locally, so I got some of these data from Oregon Community Credit Union, and their rates are virtually zero. So they have almost no delinquencies. So this kind of causes us to ask a question, or at least make some observations. What's different about a credit union and a bank? Well, a credit union often has a volunteer board. That has some issues. That isn't always a good thing necessarily, but it does create a different set of incentives for the people who are overseeing the operations of that entity. They're not for profit. They sell 27% of their mortgages. That seems like a pretty small number of the mortgages being sold. I'm not certain of that though, but that nationwide that they're retaining a lot of their mortgages. Large banks are in bigger trouble than the smaller banks. You might ask what kind of incentives are causing these differences. And I think part of the incentives are the large banks have a different incentive structure, so they're encouraged to take risk. That's not necessarily a bad thing, but this is a natural and should be an expected outcome. When they were taking big risks, they're seeing worse performance in a bad economy. The credit unions also are holding on to a lot more of their mortgages. They're hanging on to those. They're bearing the brunt of the cost if things don't go well, and as a result, they probably have a little stricter underwriting standards. They're being a little more careful when they make a loan than a big bank might be. So those were all the comments that I had, and so thank you. And I was going to turn it over to Ron, right?
Right.
Or Bob.
Okay, everybody smile and take a deep breath, okay? It seems like it's the end of the world, but it's not, all right? So my name's Ron Sauer. I've actually been on Wall Street since 1980, and I've had the great opportunity to get to know a lot of the highest-ranking people at Goldman Sachs, Bear Stearns, Bank of America, Blackstone, Lehman Brothers, so I know these people. And I can tell you the last year has been very interesting to me. I've been on a lot of phone calls that they use the word emergency, and I've had the opportunity to meet with the Securities Exchange Commission on the problems, conference with Goldman Sachs on the problems. In the last 30 days, I've met with the guy who's in charge and the lady who's in charge of the investments for the little country of China, with one of my associates that's in the room here. And so it's a fascinating time. So I'm not going to dwell on all those things, but if you want to ask me questions on that, great. I'd like to kind of maybe lighten it up and see if I can kind of just tell you what I'm thinking and what I'm doing, and hopefully maybe someone will come up with a great idea for me in this mess. When I first got into business back in 1980 to 1983, I talked to a lot of people who have been in business a long time. My father-in-law's in the room, and he gave me some great knowledge and advice about what had happened in his business career. And I talked to some other guys, and one thing I think we all should relax about is a lot of these people did really quite well during the Great Depression, just so you know. So people keep throwing around the word depressions and recessions, and just so you know, if you didn't live it, and I didn't live it, there was actually people who did pretty well during that time period. And, you gotta take care of your health, and you gotta take care of your mindset and obviously your family and your psychology during times like this. This is going to probably be a long, drawn-out process. Okay? That doesn't mean it's going to be that bad for you. It just means that you're going to have to put up a lot of negative information for a while. And hopefully that while is 9 months, but it might be 4 years, okay? I think personally one of the biggest problems is we have a confidence of crisis in our leaders in this country. I'm really quite appalled by corporate leaders. I'm appalled by government leaders. I think they should stay off TV. I think they should stop telling everybody that things are going to get worse, but I can't change that, and you can't change that, okay? But so I guess you got to learn to live with it. Hopefully there's a change of leadership. Hopefully the message becomes more constructive. That would be nice. But if it doesn't, what can you do? Well, obviously, hopefully you've been saving money. Okay, I hope that you've been saving money. My whole life, people have told me, and I'm in the investment business, save money. And I guess this is another, at least we should learn something from this. You can learn that if you've saved money, you were very smart to do that, okay? So that's been a very smart thing that hopefully you've done the last few years. Now, one of the things that's not in all these negative statistics, by the way, is we're not in bad a shape as everybody keeps telling us, because first of all, very few people are really caught up in the subprime housing problem themselves. They're going to have other problems. And then we have these things called 401ks, okay, that we've been building since the early 90s. And they're not in these statistics, so you know. It's the government statistics, not all the statistics are great. So hopefully you've been saving some money, and hopefully you have a 401k and or retirement plan and or you have some pension money coming in, and protect that, okay? Protect that. And hopefully you protected it pretty well the last several years. Now is a pretty good time, by the way, to start investing money. So if you have investments, just make sure they're sound. Don't panic now. Hopefully the foundation of your financial plan is you have savings, and hopefully you can have the courage to invest some money here in the near term. I was investing money every day this week, as I talked to a friend of mine earlier. Every day I was putting money into the stock market. And to be quite frank with you, I have treasuries, and I've had a lot of treasuries the last 15 to 18 months because I have not been impressed with the leadership in our country. So I'm starting to invest money. Whether that's right or wrong, I'm telling you what I'm doing. I think it's okay to start buying equities in mutual funds. General Electric's a perfect example. There's a great company. Are they going to be here in 3 years? Of course we think they're going to be here in 3 years. Do you know that for a fact? No. I'd rather see you buy mutual funds that have strong companies in them. And by the way, there's some good news on that also. You hear about all these companies that are borrowing money and are in trouble, but you know what? There's more public corporations in the United States today that have no debt than in my lifetime. I mean, a lot of these corporations actually have been very well managed. I think Nike locally has done a pretty darn good job. They just had a really good quarter, okay? So buy mutual funds with strong companies if you have money to invest, okay? Be careful about short-term opportunities and interest rates, okay? The reality is the U.S. government is in worse financial condition than we've been in a long time. That's the reality. It's not your problem, it's their problem. But at some point in time, they're going to have to solve that problem. And the country of China and the country of England and other countries that lend us money will cause our interest rates to go up long term. Our cost of borrowing is going to be higher. Not in the next 6 months. So don't get too excited about locking your money in long term. I worry about that. I wouldn't dream of locking my money in long term on interest rates right now. Some point we're going to have to pay the price. We're going to have to pay higher interest to the people that lend us money. Okay? So be aware of that. Be careful. It's okay to get a little bit, but just don't get too carried away with that. I'm going to assume personally that I'm going to have an opportunity in the next 5 to 10 years to lock into double-digit interest rates again, maybe even in municipals. Lord help us. Maybe. Okay? So I just want to be careful about that. I saw people get really hurt when I first got into business in the early 80s on that. So, you know, save money, get a good return, okay? As everybody's worried about the Great Depression, you know, just worry about higher interest rates down the road too, okay? So you got to be smart about this. What I'm saying is be balanced. So you wake up every day, the first thing I want you to do is address your health, okay? Mentally, physically, I really do. I mean that. Without that, you're no good to yourself. Second of all, as your financial health means savings, investing smartly, balance. And until you hear a consistent, constructive message from the leaders, which I am optimistic will happen, by the way. I want you to know that. I really, truly am. Sometimes things have to get really, really bad before they change. And that's what's happening here. Our leaders had let us down terribly. I'd be happy to tell every one of them that to their face. And hopefully, in times like this, new leadership stands up. And they do a better job for us, which will give you more confidence, which will then lead to things improving. And the good news is I had an interesting discussion with this gentleman at the country of China. So forget about, what I think, or, he still thinks, and this is, a few weeks old, but that this could relatively be short term. I mean, I think what he's talking about is 12 months or less, which would be good. The economy is getting, by the way, October was a bad month for this economy. When I say bad, okay? So we're not talking about the economy again, but the economy is going to be bad for a few months here, okay? So, but he thinks it could be short-lived, and the reality is it's just mind-boggling for us to know the numbers. If you can believe this, and then I'm going to get off, but this gives you reason for optimism, because you're going to hear a lot of negative stuff about the U.S. economy. Is the country of China, they just had a 7-day holiday over there. Their retail sales year over year was up 21%. Why? Because there's a bunch of consumers in China now, I was just over there, running around with money and confidence. They have confidence too. And their stock market, by the way, has crashed worse than ours the last 18 months. But what they have going for us is they're great savers, okay? They're pretty conservative overall, and of course their economy is doing well, and they have confidence. So China's slowing down just like everything else. It's slowing down dramatically, but I just want to give you an impression. Once we get on the other side of this, China's going to grow, South America's going to grow, Middle East will probably continue to grow. It's going to be okay. And the other thing that he thought, which was just to pass this along, is they still have confidence in our Federal Reserve. They still think we have the best Federal Reserve in the world. Now, that's being debated in the press, but it's really important since we owe them a lot of money that they have confidence in us, right? So, I want you to have, that gives me a little confidence that a year down the road, this could be a lot better than it seems like right now. So what's going to happen here, and the other thing is, just so you know, the reason why I was putting money in investments, I was investing money that I had saved in treasuries, and I still have treasuries, this week consistently, is because everybody's now addressing the problem. This is like everything else, you guys. I mean, I see a lot of very experienced, very successful people in the room. It's important that people address problems, right? It appears politically we're addressing a problem. It appears now financially we're addressing problems. This is good news, actually, okay? So let's just assume we've been pretty good problem solvers for, century after century after century. We're getting more help this time than we've ever had. We're getting help. It's really important that China and England and Japan, we're all working on this together. There's a lot of power in that, okay? So, So, you know, if you ask me, and I don't know, as you know, I don't know any more than anybody else in this room, there's some pretty encouraging signs here for us, as long as you have some wherewithal to withstand the short-term pain, okay? And, you know, so hopefully we'll wake up a year from now, U.S. economy will be improving pretty dramatically, actually, I would hope. You guys and I feel a lot more confident in our leadership. That would be nice, wouldn't it? And, you know, hopefully if you bought a mutual fund, it's up pretty substantially, because I would think it would be if that's the case. And, you know, you will have some money saved, hopefully. And you'll be saving money in the meantime. And the last thing I'm going to say that is pretty obvious to me, and so we manage money, right, for institutional accounts worldwide. So every day I have to give my employees a pep talk. I'm not going to tell you I don't. It's pretty depressing, to say the least, okay? I tell them, look, you get 2 minutes a day. 2 minutes, go as low as you want to go. Just get depressed. But the rest of the day, roll up your sleeves, get to work. This is a great time to do that. It's not going to do any of us any good to sit around and worry about it or, you know, get really paranoid or depressed. But, you know, maybe you can save a little more money during this time period, and maybe down the road you'll feel, you know, much better off financially and emotionally because of that. So that's all I got.
Well, I appreciate Ron's optimism. My name is Bob Jesenik, and I do think it's important to be optimistic. Ben asked me to kind of share what we're actually seeing in the street day to day, and so I'm going to take a little bit of a different perspective, and Ron was perhaps more on a macro level, and I'm going to be more on a micro level in terms of some of the things that we see and know.
That's why I went first.
And it's interesting that a lot of things we're talking about are actually economic theory, which when you go back to our education, we're both in the business school, but it really is real world in terms of what's impacting our investment theses. I'd also like to just preface, even though I'm going to talk about some things that might be interpreted as being dour on the economy, I'm really not. And I want to preface by saying our firm has extreme confidence in not only the American worker, but the American entrepreneur and the American business owner. And so we're all going to go through some difficult times, but that doesn't mean that we're not going to come out successfully and effectively on the other end. So with that, let me just kind of jump into a couple items here. First of all, our firm lends money to what I call Main Street businesses, so businesses that have a net worth of under $200 million or maybe revenues under $200 million. So we're dealing with really kind of the $20 million manufacturing company down here in Eugene, or the $50 million distribution company in Spokane, or the $100 million communications company in Chicago. So we're down at the lower end of what's called the middle market. And I think one of the things that's been kind of interesting to me, and probably to you, is if you go to the mall or you go to your children's football game or soccer game, you really haven't noticed much of an effect yet in terms of talking to the other parents that are there. At least I haven't. And that's because it really hasn't necessarily filtered down yet to Main Street. And I'm going to come back and talk about that a little bit, because I think that's really one of the things that if we can share with you how we think that's going to occur, then maybe you can be planning from your perspective of how to prepare for that. So our firm, we lend and we invest in privately held businesses for the most part, though we do some small cap. We also lend to hospitals, so we're really involved in the healthcare sector, which fortunately is really not correlated to Wall Street. And then thirdly, we're involved in investing in renewable energy categories. So we're really dispersed a bit in terms of our worldview, and I think that helps provide a foundation for how we're looking at things today. So what I'd like to do today is really just take a step back and talk about three things. One is real estate, two is leverage, and the third is really making sure that all of us take time to relearn the definition of equity risk. And by that, what I mean is that in America, at least in my generation, and Ron and I had the good fortune of graduating at the same time down here, I think the preponderance of American investors have forgotten what the definition of equity risk is. And I think we've become a bit entitled in our view that if we invest in a stock, we expect it to go up. And if it doesn't go up, it's somebody else's fault. And if you really stop and think about that for a moment, I think there's some interesting research and analysis that the business school and other academics should be doing around that whole area, because I think one of the things that we're all learning is that, there are risks in equity. It doesn't mean it's bad, it just means there are risks. And, in times like this, you will see things go down. But I'm going to focus on real estate, and I'm going to focus on leverage here a little bit, because that's kind of our area of understanding and expertise. The analogy I'd like to reference is really one to kind of put what we're seeing minute by minute every day, is really the whole analogy of each of us having a personal home and each of us having a mortgage. And as you all know, most people put 10 or 20% down to buy a home and then borrow the rest. And if you could imagine what would happen to the value of your home if today mortgages were outlawed and no one could have a mortgage, if you wanted to sell your house, what would happen to the price of your house? Okay? And if you think getting mortgages are difficult today, it's 10 times as difficult for people to get credit today. And that's really a big function of what we're seeing today. So everybody that was used to borrowing money to buy stocks in the market, or people that were used to borrowing money to lend to other people, that whole set of musical chairs stopped. And I think some of the charts that we saw earlier kind of reflected that. And so as a result of that, that's why we're seeing falling prices. And it's not just in the stock market, but I'm sure, and it's not just in your home, but if you look at the value of your car, you look at the value of your commercial real estate building, you look at the value of any asset, they're all dropping in price. And the reason is because the prices can't get propped up with debt anymore. That's what's going on, and it's going on real time. And I think that's going to change, and I think we have to go through some of the pain that Ron was talking about, and the good news is we are, because if you don't get through it, then you can never recover and move on. But I really wanted to put that in perspective for you, because that's really what we're seeing out there in really almost every category. The car dealers are one example. The reason you can almost buy a General Motors for the price of a Suburban is because of the fact that they are not able to finance their customers to buy cars today. And that goes on throughout lots of different categories of the marketplace. So I think one of the things that we've all been surprised with, certainly I have, and I'm no expert in all this by any stretch, is that there really is a much larger interrelationship between the federal banks of the various economies of the world, between the major banks. And I don't think this interrelationship was really truly understood even by our leadership, getting back to Ron's point. And so what's really happened is we've got a situation, I don't know if you all know this, but over the last couple of years, there's probably been $100 billion plus raised in what they call distressed debt funds, people sitting on the sidelines waiting to buy at vulture prices distressed assets. And over the last even 3 months ago, people were talking about how that money hasn't been invested yet. And the reason is because we really don't have distressed debt yet. We have distressed lenders. And so what we're dealing with more is how do we deal with fixing that issue. In our world, that's what is contributing to what we call a credit freeze, and is really calling, in a lot of ways, an incredible acceleration of deleveraging. So getting back to my house and mortgage analogy, if it all stopped today, what would happen to the price of your house? That's what you're watching on Wall Street. And the government every day is implementing new steps, and some of these steps they probably could have implemented 2 months ago, but they didn't think they needed to. And so we're playing catch up a little bit, and that's partially what you're seeing. And the rescue plan, I think we're on version 10 by now, and I'm sure we'll see another 10. Yeah, 11 on Monday, exactly. So again, I didn't want this to be negative, but what I really want to do is set the stage for what we're seeing, and then set the stage for what we're doing about it, because we are, like I said, encouraged about the opportunities going forward here. All these facts, though, that I just shared are really contributing to a mentality which basically says, don't buy today what you can buy cheaper tomorrow. And if you stop and think about it, that's really what's going on. And my wife and I were driving over here, and we saw a couple of stores are having big sales on. I mean, everything's about discounting price to sell things. And so realistically, if it's a business you're looking to buy, or a car you're looking to buy, or whatever, or home, I think, what people are really thinking on the street is, why buy it today when I can get it cheaper tomorrow? And so that has some impact for all of us, and I think has some real impact for Main Street, and I'm going to talk about that here in a minute. So what I'd like to do is just share three real-world examples of what has happened in our world the last 2 weeks, because you don't really read about this in the Wall Street Journal, and it's really, in one regard, it's been kind of wild to read the headlines in the Wall Street every day, but they're really not getting into what I'd call some of the real-world things that are going on here. So let me just give you 3 examples, and then I'll talk about the ramifications of these, and then what we're going to do, because I really think Ron is really right on that. As negative as it is, and who knows where the Dow and the S&P are going to end up over the next few weeks, as negative it is, and as hard as it is to work through these issues, there's going to be a silver lining here. And as I tell our folks, and we have 50 folks in our firm, and we had one of those employee meetings yesterday, so I know what you mean. We have a $14 trillion economy, and even with a 5% recession, that's $700 billion. I used to say a 2% recession, but now I say 5%. But even with a 5% recession, that still leaves $13.5 trillion as something that's going to happen next year. And so realistically, the real question is, what are each of us going to do as workers, as homeowners, as family members, and investors to partake in a $13.5 trillion economy instead of a $14 trillion economy? And I really think that's the view you got to have, as opposed to thinking, oh my gosh, it's 700 billion less. We still have 13.5 trillion, nearly double the number 2 economy in the world. So real world, what happened in our business this week, and actually going back 10 days ago, I was on a conference call with some folks from Goldman, and we're actually looking to be buying debt portfolios from distressed lenders, people like Citibank and Wachovia and those kind of folks. The words they used is, Bob, nothing's going to get done in the fourth quarter. No deals are going to get done in the fourth quarter. We're all just sitting on our hands. Had a call with a friend of mine who's unfortunately works at AIG, and he's on the institutional sales side, where they're basically, they have huge hedge funds and private equity funds, and they sell them off to other insurance companies. And his words to me, I was talking to 20 of my institutional clients, so 20 other insurance companies around the country, and every one of them sitting on cash saying, you know what, we're hiding in our cave, we're doing nothing. And so there's a real-world example of what sophisticated money is doing in the insurance sector. I'm not saying it's right, not saying it's wrong, because we're actually also, like Ron said, we're investing money in privately held businesses this week and next week as well. But that's the mentality that you see out there a little bit, and that's the mentality that you all get probably from watching these talking heads on CNBC and Fox Business News and all that other stuff, right? And then the third one is, which has been the hardest one for us, because it's really hits in our sweet spot. We've been in our private equity fund. We have a debt fund and private equity fund. We've been in the process of buying a $50 million manufacturing company in the Midwest. Makes $9 million a year. Traditional middle market manufacturing, bread and butter. Been making it for 4 or 5 years. And the good news, and this is probably helpful for you all to hear, is we were able to get a $25 million bank commitment from a senior lender, Capital One of all people. But the other, we were putting in $5 million in equity and $5 million of junior capital, and we needed another $5 million from a partner for junior capital, another $10 million of equity. And one of the big money center banks, we met with their investment committee. They signed off on it, and that afternoon they had a email from their CEO. We are not doing any more new deals for any new borrowers at any price. We have to take care of our existing borrowers with our own liquidity needs that we have. And this is one of the top 3 banks in the country. So that deal's going nowhere, and let alone going back to my comment, why should we be buying it at $45 million when we can probably buy it at $35 in 3 or 6 months? So those are the dynamics for a world that are going on in our little part of the universe. And I'm not being negative on that, because I think there's some interesting ramifications that are going to come out of all this. And I'd just like to share a couple of those with you here. First of all, I think what's going to happen over the next 6 months, and that's Ron's point, I think, about the economy is going to be pretty tough, and October clearly was ugly as well. We went through the residential real estate slowdown, and what that really means is, whenever that happens, the real estate broker doesn't get their commission, the mortgage broker doesn't get their commission, the title company doesn't get their fee, so on and so forth. And through that process, guess what happens? You see a lot of dislocated folks. Well, we're going to start seeing that now in what I call the commercial sector. So what that really means is the investment banker isn't going to get their fee, the lawyers aren't going to get their fee, the brokers aren't going to get their fee, the borrowers are going to pay more, and so on and so forth. And so we're going to go through that process, and we just might as well understand we're going to go through it and then be prepared to deal with it. As all that happens, there's going to be spillover to Main Street. And what I mean by that is, when the average business, whether it's GE on the big end or the $20 million company down here in Eugene, when it's harder to borrow money, they get less revenues and they have to tighten their belt and cut costs. And I can tell you, even in our firm, we've added 30 people in the last 3 years, and we've trimmed a few deal folks this week because we know the next year is going to be tough. So the velocity is just going to be slower. The other thing that I think we're all going to be dealing with, it's a conversation I had with the president of B of A's business lending group in Chicago this June. They were actually lending to one of our portfolio companies, and he said, Bob, when we underwrite these deals now, we don't just underwrite to what the current earnings are. We run a sensitivity analysis for 2009 as if these businesses have 60% less earnings. So can they repay their loans with 60% less profits? So that was where B of A was in June in terms of what they thought 2009 was going to look like. So my point in sharing all that is that, okay, that's reality. So, how do we get this deleveraging behind us? When will we get it behind us? And how do we make money as investors? And so our worldview is really pretty simple. Rather than making one-off business loans to businesses, we're taking advantage of the marketplace and we're buying portfolios of loans from existing lenders who have their own distress problems. The loans aren't distressed, but the lenders are. And we can buy them at 50 cents on the dollar, 45 cents on the dollar, 60 cents on the dollar. And they might be paying 8%, but when you're only putting up half the money, you're getting 16% current pay return. Plus, you're getting the discount back over 3 years as these loans get repaid. So that's a big area for us, and actually a lot of folks, and I think you're going to see and hear a whole bunch of that. And that's really needed in our economy so our banks can get back to lending new opportunities. Because the more they spend their time wasting their time on problems, the less they're spending time thinking about how to lend you the next loan for your good business. Second thing we're doing is something we've always done, and that is kind of follow the Warren Buffett model, in the sense that if you look at what he did with Goldman and you look what he did with GE, he basically lent the money at 10%. And so he's basically in a debt position over all the equity holders, and he's got equity kickers. And so what he's really saying is, don't take as much risk being a common equity holder, be a debt holder. And so he's doing it in the form of preferred stock, but it's basically the same thing. So he's basically, if GE, I don't even know what GE's market cap is, Ron, but it's probably, obviously 220. Okay, so it's 200 billion, and he's basically said, I've got 220 billion of collateral beneath me by putting my 5 billion into it. So it's about as shrewd as you can get, and get a guaranteed 10% return, which the GE common folks aren't getting. So we're doing that at the micro level in Main Street, and just putting money into businesses, 5 million, 10 million, and getting the equity kickers as well. And then lastly, we're going to be, may not be the fourth quarter, but it'll definitely be the first quarter. As fast as we can continue to raise money, we're going to be buying businesses from hedge funds and private equity funds who have all their liquidity problems and have to sell the good companies at a discount. And so that's going to be the next wave that we see coming as well. And so I really like Ron's point, which is just because things are dour a bit doesn't mean you can't be opportunistic and take advantage of what's out there. And so hopefully I've given you a bit of a flavor today in terms of what's really going on from our end of the market, and then how we're reacting to kind of address the opportunities that are out there. And with that, I'll turn that back to you, Ben. Okay.
Sounds great. Thank you, Ben. Sounds like you're in competition with the Federal Reserve, Bob, buying distressed assets. Yeah. We've got some time now for some questions and answers. There have been some really interesting questions handed in on these cards. We spent a little bit of time going through them. Just to pick up a little bit on what was just being talked about, Ron and Bob, and Ron, maybe we can start with you. What are you hearing most of all? What's the single most biggest thing that you're hearing from your clients right now and the people that you're doing business with in terms of the overall situation?
Yeah. Well, our clients are leading institutional clients, and they have very diversified portfolios. So they are seeing real distress in their private equity portfolios, their hedge fund portfolios, and in their equity portfolios, all. They, quite frankly, have never seen anything like this, and so they're pretty frozen. And what's more of interest that I can tell you is that we kind of slice the world up because we have a world marketing effort, and we believe that the people in Asia are probably the more objective and opportunistic investors in the world right now, along with the people in the Middle East. Yeah. And what's ironic about that is that a lot of those institutions have made a lot of money in the last 20 years, but 10 years and 5 years until this year. So they're looking at our U.S. assets as attractive. So they actually look at our U.S. corporations as being many of the strongest companies in the world. I can tell you China Telecom is definitely one of the strongest companies in the world. But they look at companies like Google, companies like Nike, companies like that, Starbucks even, as being, very strong companies. The other thing that's ironic is the financial companies. Quite frankly, that's one of the biggest competitive advantages the United States has is our financial services companies. We are definitely have a head start in intellectual capital and systems to be successful. So part of Wall Street's problem will be fixed by exporting talent. There's a lot of people that I know that used to work in San Francisco and New York that now are working in Beijing or in Dubai, and that trend will continue. So in the near term, the way I look at it is that I'm trying to look at it the way the international investor looks at it, sophisticated. And if that's the case, then our companies, which means our people, our products, our services, and our brands are undervalued relative to other investment vehicles. And so I do think that this is an opportunity for us.
Okay. Bob, you have, what do you see most of all from your clients right now? You described some of that already, I think. But.
Yeah, I think what's kind of interesting that is maybe not as well appreciated is from a world view, the international folks see America as a buy, and really we're in conversations with one of the largest French families to run a $400 million private equity fund for them, and their whole strategy is getting out of the euro, getting into the dollar, and taking advantage of the lower valuations in the U.S. And so it's really nothing to do with the credit crisis. It's nothing to do with the Dow dropping. It's got everything to do with their macro view of the U.S. being a great long-term opportunity. And that was really my very opening comment, in terms of the American entrepreneur and the American worker and what have you. So on the one hand, I hear those kinds of things and have those conversations with investors. And on the flip side, I think Ron's right, and kind of what I alluded to earlier, people are somewhat frozen. Those that have liquidity are willing to put it to work, but those that are really looking at their portfolios and are fully invested are, really just saying, okay, I'm going to do nothing, and I wish I could take my money and put it under the pillow right now. And so it's really both extremes of what's really going on.
Yeah, and I just think that we, way I look at it, we've become the new England. When I got into business back in the 80s, everybody was talking about what had happened to London. And, we're just very negative in this country. Yep. And, we're too hard on ourselves the last 3 or 4 years. And, I think that if we can get a lift in that leadership and that's, again, across the board in private enterprise and public company leaders and government leaders and political leaders and everything, then it's going to have a big impact for us.
And I'd like to echo that, Ronnie, because that's a really important point. When at 87, when I went back on my master's, everything we were talking about was how brilliant the Japanese were in management and how dominant their economy was, and we were really the ones that needed to learn what was going on. I remember writing in a paper about that even. And it didn't take, 3-4 years till 91, and then boom. And so it really is easy for America to be hard on itself. And really, if you look over the long run, even in the short time period we've been in commerce and the $14 trillion economy that's been created here, it's easy to lose sight of that. And I think that's a very good point.
Okay, thanks. John, your clients, you want to add anything?
I'm asking when their homework's due. What's going to be on the test?
Excellent. All right, we got some pretty interesting questions here. We can have open mic here, but maybe we can get through a couple of these ones that were written down here. First of all, and this is for anybody who wants to jump in, what will be the effect of the G7's failure to act to guarantee interbank loans, a failure that apparently happened today, or on the economy in general and on the markets? So what would be the effect of the G7's failure so far to come together? Yeah.
Well, it's going to have the same effect that the rescue package did. It was, shot down to start with. It's the initial response is not going to be positive. There's a long time between now and Monday morning, so the Bank of England's working hard to try and correct this. So it's critical. You saw in John's chart that it's critical that banks have confidence to lend to one another. And that problem has to be solved, and it's a solvable problem.
I was just going to add one thing that Bob mentioned earlier was he said if banks won't lend each other at LIBOR and that rate has been going up, who's going to buy their equity? Their debt is senior to their equity. I think that's an excellent point. And I guess the other thing I think that's important to keep in mind is if the government entities are trying to use the WD-40 here is my analogy, and ultimately we don't want our governments to be in the business of running banks. There creates all kinds of incentive problems if the government just gives banks money and they can lend it with impunity without bearing consequences of making bad loans, and we see that happen. And so I think there's this very fine line between providing the liquidity but not kind of setting up a system that's doomed to failure, like in the 1980s when we saw the savings and loans kind of in crisis because they had a very poor system of incentives in place at that time. So I think they want to provide help now, but we want them to be getting out of Dodge as quickly as they can on the other side.
The only other thing I would add to that is, and I'm thankful I'm not in D.C. as a politician, is that really if the banks are going to be invested in by the governments like they're doing in the UK and like Hank Paulson's talking about doing here, they're basically guaranteeing the LIBOR lending between the banks anyway, because if they own the banks, then they're basically guaranteeing the debt anyway. So in a way, it's almost a facade to say that they're not coming out to guarantee it when they're, on the other hand, saying we're going to go buy all the banks. So I really don't understand some of the whole thought process, to be honest.
Okay, thanks. Here's one.
One thing really, the important thing is they're working on the problem together. That's one thing we should all have confidence That's more important than anything.
Stay tuned. All right. Similar, but on a different topic, back to mortgages. Approximately 6% of the total housing inventory is in default. If the government buys down mortgages, won't this in effect lower the values of the remaining inventory? And could that trigger more defaults, as those affected will now be mortgaged more than the reduced values?
I would actually add another statistic that I saw the other day that's actually equally as concerning, and that is that if you take all of the acquisition and development loans that the banks have, you know, for the lots that you see the builders do when they put in the streets and all that kind of stuff, it's 106% of Tier 1 capital of all the banks in this country. And so, you know, if you look at a 6% delinquency rate on these mortgages and what have you, it's now at least that delinquency rate on those loans. And the banks haven't really taken their major reserves yet. You're just starting to see them. I mean, in Oregon, we've seen some of the home builders go bankrupt, right, and so on and so forth. It's putting pressure on a couple of the banks. That is really, I think, where the bigger pressure point is going to be with the banks. And if you go back to John's graph on the big banks versus the community banks versus the credit unions, I'm sure it's the same exact allocation of who has which of those loans. So realistically, how we handle the liquidity of absorbing that inventory and not taking too big a write-down is going to be, to me, more of a concern than the 6% delinquency on the mortgages.
One thing, I think it's a great question to start thinking about kind of delinquency rates on mortgages, and this is something I don't really know the answer to, but it seems like an interesting exercise to really think about kind of how people, are people better off having taken out a mortgage 5 years ago, bought a house with it, and lived in that house for the last 5 years? And I think, you know, at least in my case, I'm in that category. You know, I went to the bank, I put some money down, I borrowed another 10% from another bank, and so I had one of these 80-10-10 mortgages, and we've had a great 5 years in this wonderful house, and I'm luckily in the 95% that's going to be to continue making my payments. So I think you kind of have to think of, I'm kind of getting fired up here by Ron's optimism, and wanted to, you know, you think about 95% of the people, hopefully it will continue at that level, making their payments, living in a nicer house than they might have otherwise been in because of access to this capital. So I think there is a glass that's not even 95% full, potentially to look at and to think about. So.
Take care of your health. Deep breath. It's not all bad renting, you know. Sometimes rentals can be just as nice of a home as owning a home itself. So, yeah. Apartments too. Yeah, apartments too. Exactly.
I'd actually add one thing too. That's I think when the government goes in to buy some of these mortgages, to the extent that these mortgage paper is so distressed that the price is bouncing along, let's say 20 cents on the dollar, and they actually come along and buy it at 30 or 40, the question supposes that drags down the value of the remaining inventory, but in a lot of cases might actually pull it up. That's one of their hopes, because they're already bouncing along the bottom so much, at least the kinds of mortgages that they're talking about buying.
Well, you know, one really positive thing that Bob said that I don't think he even said it was positive, but it is definitely positive. He said that he is raising that they're taking their money and they're buying distressed portfolios at 50 to 60 cents in the dollar. The fact is that Bob and Goldman Sachs and a lot of people are now doing that. They weren't doing that 3 months ago. Okay? So this is positive. That's actually positive news. I'd say the same thing about the housing market. Nobody knows when it's going to bottom, but it may be bottoming right now, residential. I'm not saying it is, but the point is, in my neighborhood, I've seen houses now sold in the last month and a half. Now, hopefully that'll continue. But you know, again, you just got to take care of your own house. You got to take care of your own apartment. You got to take care of your own financial health, your real health, and at some point there just won't be bargains. So at some point they take the sale sign off, and you know, so you got to think of it like that too. So if you see something you want to save or invest or whatever, you know, do a little bit.
Okay. All right, one more.
You're buying stuff.
Here's another technical question. With asymmetric information, wouldn't a reverse auction ensure that the worst and riskiest mortgage securities are sold first, presumably to the Federal Reserve as a part of this rescue package, guaranteeing that government will overpay? With asymmetric information, wouldn't the reverse auction ensure that? Anybody want to?
It's a good question. I'm not sure I fully understand the reverse mortgage process or the reverse auction process. In fact, I'm sure I don't. But I think asymmetric information, I mean, what that means is just that the person selling that asset knows more than the person buying it, or the government who is offering to buy it. And that always creates problems. And in fact, it's probably the government is the only one that's interested in buying it. They're the only bidder, and almost doomed to pay too high a price, which is one of the real concerns. And I alluded to it in terms of taking these distressed assets off the books by the government. You know, we want to make sure that the government's getting a fair price. So it's a good question, and it's a real concern.
The only other thing I might add is that when you read in the paper that oil hits 145, it doesn't mean that everybody is paying 145 for oil. It means that the highest, most recent bidder, even for one barrel, is at 145. And I think the same thing applies here, and that is that, first of all, it takes a lot to give these big banks credit. They know the real value of their collateral, and they actually know which of their collateral is distressed to begin with, because I really think you're giving them a lot of credit when you do that, because they wouldn't be in the position they're in if they knew that. So that's number one. But then number two, realistically, they're motivated to get the highest price. And so in this world of mark-to-market, which has really been a big part of what's created the problem here, and I'm not saying mark-to-market is bad, I'm just saying maybe how it's implemented is not the best, that realistically, what these lenders are really wanting to do is not dump their worst collateral, but get the best price. And so whatever that takes is really, I think, what's going to be motivating them, coming back to the risk-reward, incentives that they're really structured today to pursue.
Yeah. And presumably, too, the government could put out bids for just certain types of mortgages and try to stratify them somehow and not just go for the worst of the worst also. Okay. Why don't we open it up to you now, and people who have questions, we can make this interactive here in our last few minutes. Sir?
Yeah, I don't understand, as I understand it, if a bank is solvent, needs money, and they can't borrow it from another bank, they just call up the Federal Reserve and borrow the money. And of course, if the Federal Reserve or the FDIC determines they're insolvent, they simply close the bank and sell off the assets. So why is it, I mean, in other words, the Federal Reserve is the bank of last resort. How come they're not lending the money out and keeping this, you're telling me that they don't lend each other and that's tightened up. Well, that's what we got the Fed for.
That's part of the confidence crisis that we have, is that nobody understands what the Federal Reserve's list is week by week of who they're going to lend money to and who they're not. And, quite frankly, it would have been much better off if they had put out one strategic, easier to understand plan for everybody. Lehman Brothers, as an example, did not understand that they wouldn't be there for them. That was a going enterprise. Everybody knows that. And then it'd be very
Corporation, they didn't know that.
Right. But they were in discussions with the Federal Reserve and Goldman Sachs, and that's another subject. But to your point is that you shouldn't understand this right now, and that's why we have a confidence crisis. And then once everybody understands that it's a fair system to all banks, then you'll probably see this market bottom and all the markets worldwide bottom. And that's why the G7's now working together on the problem, and that's why we need the G7 to work together, because all the governments need to have the same message to the financial system, okay? And so, you know, I guess when you pick up the paper and you understand it, then that'll be really good news. And probably the stock markets will have had a couple of really great days, you know. So let's hope you understand it soon, okay? I'm hoping for you. You're no different than the rest of us.
Andy, right behind you is another one.
Thanks. I'm not sure if this is on. Okay. There we go. I feel like I almost have to stand. I feel like I almost have to stand up and say, "My name is Ellen, and I am a psychologist."
Oh, good. Here comes help.
Okay. No. Actually, I have a question, really.
Yeah.
How much do you think the crisis is due to excesses of emotional reactions, as opposed to the emotional reactions really being reflective of what the actual situation is? That we don't know that much about going on, that we didn't do a good job predicting this.
Boy, I'm not going to argue with you about this, but you know, I think that it's my business, the stock markets, right? And I'm beyond worrying about stock markets. I'm worried about the real world and have been for quite some time. And you know, I really truly think that obviously there was excesses. We had a huge excess in the housing market, which was fueled by lending, okay, on the long side, which created more housing activity. Then we had a huge excess in the commodity markets, which again was fueled by lending on commodities contracts, okay? And our major financial institutions, as well as the major financial institutions worldwide, fueled that, okay? So they fueled that excess, right? And it really is just that simple. It should have been no different than if you remember when Mr. Greenspan in 2000 said we have irrational exuberance on stock prices in the U.S. So he had a very nice way of saying, hey, stocks are way overpriced. Watch out. That's what he was saying. And he was right, and stocks tanked for a couple, for 2 to 3 years. That's what we just had in housing and commodities. And I think the problem was that exacerbated this was a negative message day in and day out from our leadership versus solving the problem. And that's why I get back to, and psychological terms, I'll leave you. But I think that the negative message about how bad it is was not what the markets worldwide needed. I think what the markets worldwide needed was, hey, we made some mistakes in this market, we made some mistakes in that market, too much money was lent to prop up those prices, and now we're going to pay the consequences. And this is what we're going to do to solve it. And unfortunately, we had to go through this process, I guess, to start actually working on solving the problems. I think once all of us start to see that we understand what's happening, and we see that problems are being solved, then I think we can actually have a pretty quick rebound on the other side of that. And hopefully that's not, 3 years from now. Hopefully it's more like 3 months from now. And he really wants to ask a question.
Wait.
Yeah.
Sorry, hold on 1 second, please. Hold on 1 second. John, did you want to?
Yeah, I just wanted to pipe in.
Something?
I think one of the things that we see is individual traders and investors don't know what things are worth, and they don't trust each other to know that what they're telling them is what something's worth, and they're understandably wary. And I think we saw that in a huge way yesterday. If you think about that volatility yesterday in terms of dollars. I mean, I can't do the calculation in my head right now, but it's on the order of $1 trillion, I would say, in terms of valuation changes on a single day in 8 hours. So in the morning, people thought things were worth $1 trillion less than they thought in the afternoon. I think also you see it in transaction spread. So if you actually look at the very details of the trades that are taking place, there's been a very large or a very noticeable increase in the prices between which people buy and sell. So and that reflects some of that that uncertainty and that lack of trust in the market. And so I think that's one of the big things that we have to work on, that everyone can see all the pieces so that they can trust them by looking at them themselves.
And I would add one other thing, that is that the speed of information and the impact of the media tied into the financial instruments that are available to be done through new technology, I don't know that we've reflected enough on how all that interrelates. And I hope over the next few years we'll actually take a step back and think about that. Because I don't think regulation has been able to keep up with some of the financial instruments, and certainly SEC has been not on top of certain things. But at the same time, I'm not sure what I'll use an example, getting back to Ron's stay healthy piece. I was on the treadmill yesterday morning at 6:30 watching Fox Business News, and the announcer was literally cheering as the Dow was coming back from negative 600 to zero. Now, why are we cheering when the Dow is at zero? I mean, think about it for a moment, right? It's almost, what is the real role of, we all want a positive Dow, but the point is, what's the real role of the media? What's the real role of information dissemination? And how does all that really impact, regulation and behavior? If you go back to 2001 when Enron blew up, and it was kind of, one of these surreal things, and how could a $100 billion business, right, blow up like that? And a big part of the issue was confidence and trust, right? And realistically, we learned some things on the accounting front, and Sarbox came out, and so on and so forth. And what we also learned, though, there was unintended consequences. And I think people today are really concerned about unintended consequences. Okay, and so if you go back to the subprime thing that started a year ago, what did Bernanke say? He said, we want to contain this, we don't want a contagion, so on and so forth, right? And well, guess what? It didn't get contained. And so I think a lot of this is about unintended consequences, and that's really what the media fans from time to time. And I don't know what the answer is, but I think those are some of the points coming back to your question.
We got time for a couple of more anyway. Andy, you've got one right next to you there.
I was going to say that a comment on all three with all three. I don't really need this.
Yeah.
Like Ron mentioned about, thinking about the greater world, not just the stock market, that's really good. The guy in the middle, I apologize, I don't know your name. You mentioned the spread. Well, people made a fortune on those spreads yesterday and the last week. We're not talking about that. And the other guy mentioned we all wanted the Dow to come back. Well, I disagree. Some people made a fortune on puts and shorting the market. Let's be honest. And it's like people aren't mentioning in the newspaper or not, but there's a lot of money been made this last week. And that can be a good thing, I guess.
Excuse me, do you have a question? Please.
Why is the media not talking about that at all? There's a lot of money made as well as lost.
Yeah.
What's up with that?
Why is the media not talking about all the money that you believe was made?
On the puts and on the shorting stocks, as if that they don't want the general public to know that part of it. That's my question.
Yep. Well, Ernie, I think
Inside secret?
no, there's I think some. I could go on this topic for an hour, but let me explain. There's a lot of money being made by a few institutions and a few people that are investors in the marketplace. It's no different than what the problem is with the main economy. Is that for years? I mean, in this case, you have Warren Buffett, and I think I can answer this to you really quickly. Warren Buffett and Bill Gates say, "Raise my taxes." I'd rather have a tax break for the middle class, and the government's ignored that. I mean, they're big proponents of raising their taxes. And what you're talking about is that, you have a few people making a lot of money on the short side of this market, and they pay a lot of money to lobbyists to keep that in place. I talked to a guy who I can't say his name. He runs one of the top 4 hedge funds in the world. I talked to him for a half an hour on Friday. He said to me, quote, "I don't understand why we have short selling in the market anymore, and I've made a ton of money on it." He says, "This is crazy." So you're right. I think it's a problem. And I'll tell you, the bigger problem I see on that is this simple, is that we have our best and brightest students that have come out of our major universities for the last 10 years that, quite frankly, they've been absolute idiots if they didn't go to work, if they cared about money, to go to work for a hedge fund or a private equity shop. And private equity is in a different position. But the problem is that we don't have a lot of young talent as a percentage that's gone out into the real economy. And I think that's a big problem. So I think a lot of people have been taught to make money on the main economy's misfortune. And I think it's just an excess. I don't expect it to go away. but it is going away right now. And so I think once that's also part of counterbalancing this. So when there's less people making a lot of money on the destruction of American companies and companies worldwide, then that'll also be a sign that, you know, we're improving, that we're solving that problem. Because that's also related to psychology question too. So yeah, I think that this process will be good for that also.
Almost the first time, like when they didn't want to be betting on terrorism, the one group creating them wanted to set that up. Remember that? It wasn't terrorism. It almost felt like that this week, that you could be betting on.
I agree.
Economy terrorists, a little guilt, but guilty pleasure.
Andy, have some more people with some more questions, please. Actually, we do, because it shows up on the tape, please. So it does work. So you got one right next to you on your left there. On your left.
So what do you, the hedge funds are all big news and all this. They're levered, and there's a huge delevering of the world.
Yes.
So what's your view on the hedge funds? Do you think we're going to see some large hedge fund biting the dust soon?
Well, we already have seen a tremendous amount of large hedge funds that are, and large private equity shops that are liquidating or are being liquidated. And the problem is they weren't hedge funds. Okay, you know, a hedge fund is supposed to hedge its investors against exactly this situation. But a lot of them are down 60, 70% for the year. When I say a lot, quite a few. So, I mean, that's right, they're self-liquidating. And because they're being delevered, they're forced to realize their losses. So that's happening. That's actually a good thing in this process, is that's happening. And so, and the bet they made, so you can understand it, I mean, there's a lot of different bets, but a lot of them were long commodities with borrowed money. A lot of them were long distressed paper with borrowed money. And a lot of them were, you know, short, you know, the wrong, you know, the wrong stocks. And so if you add all that up, they've ended up losing a lot more money. And so a really good hedge fund would right now be probably only down 6 or 7% for the year. And, you know, that's now becoming a pretty select crowd. So I think it's a positive. I think that's the natural forces of capitalism. I mean, of all this negative stuff, them being delevered will really help us out, and then that'll start to prop up valuations. And so I think Bob's pretty smart right now to be buying a portfolio of distressed paper at 50, 60 cents on the dollar. I mean, that, you know, because he's taking advantage of people who have to sell those portfolios that, you know, used to make a lot of money and they're not now.
And I would add also, you know, October 1st was a notice date for redemptions for a lot of hedge funds, for year-end redemptions. And I think what you see in the last 2 weeks is, you know, not only just the delevering, so they're selling into a bad market, but they're also not able to reinvest because they got a hold of their cash to give it back to their investors. And a lot of investors just want their money back because they don't understand and don't trust what these hedge funds are actually doing. And so that's all good for the market too, because it's just going to take risk out and rebalance things a bit.
Yeah. I mean, Friday was a tug of war. That's good news. Market was fighting.
We got time for a couple of more, and then we'll invite people maybe to come down afterwards. It will work. It's okay.
Hello.
My name is Rana. There it came on. Hi. Eugene resident. I'm more in line with the fellow with the shades. There's a lot of money being made on at the top. Corruption is the trickle down. I don't care if they make all their big money. Actually, I'd rather make my money ethically. So I don't see the optimism in how you can buy all the distressed property and the distressed portfolios. I'm more into the savings now, but I don't believe that this is an accident. I think it's more by design. I've been seeing it on the internet for the last couple of years now.
Absolutely.
Actually, that it's coming. Didn't know exactly what was coming. But since I'm more into savings and I'm seeing that the FDIC is going to raise up to $250,000, but they only have money for 1% of savings of the banks. and that now the G7...
Rana, excuse me, do you have a question, Rana? Can you please
Get
ask
to the question?
Please.
I don't see what's being offered by any of you for just the savings person doing it, how to make their money ethically in savings and have it protected. Is the FDIC have the money? Do they have the money to pay for all the banks if we go into a depression? Ben Bernanke, by the way, his expertise, educational expertise, is the financial depressions.
Right, right. So the question is, does the FDIC have enough money to make good if all the banks go bust, or to insure to the limit?
Yeah.
Yeah, well, they can always print as much money as they need in the last resort, so hopefully it won't come to that, is one answer.
It's not worth anything with hyperinflation. We know that from Germany.
Well, we do know that.
Yeah.
So that doesn't happen.
Well, hopefully all the banks don't go bust, because there's not such a run on the banks, because maybe confidence is restored. The intention is to, that's why the limits are being raised in the first place.
I think
So the FDIC only has about 1%.
well, the key is they're an insurance. I mean, they're providing insurance, and all insurance companies are, banking on if every bank goes down, they don't have enough money. But if a few banks go down, they do. And the way banks go down is if people start pulling their money out of their banks all at once. And so by guaranteeing it at $250,000, they're saying you don't need to pull your money out because we guarantee it up to $250,000. And that way people don't run to the bank and pull all their money out. And that's what causes the contagion to happen. So the hope is that's, in my mind, a very, very important act that they've taken to so that people who have more than $100,000 at the bank don't go line up at the door and say, I need my everything over 100 in cash, and because the banks aren't going to have it if everybody did that.
And you actually brought up an important point. We don't want to be in this situation that Germany was in when they went through that, and we're not. We're not isolated. And that's why it's important that the G7's working together on all this, because in the end, it's the world's central banks is the insurance fund for your savings.
And you should also get comfort in the sense that this week Treasury said that they're going to plan to invest in the banks, which basically is another form of FDIC insurance. So it's much more than just the FDIC fund that's going to be available to protect the banks. I think that's a big point too. Mm-hmm.
Maybe we can take one more and then invite those of you, there are a lot of hands up, but we've already kept everyone here quite a long time. Afterwards, if you'd like to come down and maybe on a more personal level ask something for as long as, whoever's up here, as long as they're willing to stay around, I invite you to do that. Maybe we'll make this the last one.
Okay. I have a very simple question. Are we going to hold anybody responsible for this mess?
That's a great question.
I would start from our legislator all the way down.
Well, you get to vote November 4th. And I think it'll be a pretty loud message.
Yeah.
Well, thank you for coming out. On our website, you will see a calendar of events. When you have a chance, let us know what you thought about this, and we'll be listening. And thank you.
Yeah, sure.
Thanks. I was born in the 50s. I told folks were kids during the Depression. My grandparents raised me. So, am I the way that investment? I mean, they